Welcome back, traders and investors. We have our final guest of the day, and that's Craig Erlam, and he's a market analyst at Alpari. Craig, how you doing this morning?
Very good, very good. How are you?
We're doing good. Just was looking at your background and see you spent some time at Goldman Sachs. When did you work there, and what did you do?
I worked there when I first moved down to London, so that was about 3.5 years ago. Spent a year in the operations division. Basically, it was a great opportunity to get a move to London. It was a great opportunity to get in a good environment, I guess, and also meet some good people, make some good contacts, and all. Like I said, I think it's the work environment which was the most interesting part, just because you really got to know what it was like working around these people, working around these traders, and working these longer hours, which I think gets you a very good work ethic when it comes to moving into the type of environment that I'm in now.
Okay, and are you from England?
Yes, I'm from Liverpool, so north of England.
Okay, home of the Beatles. All right, all right. So you work in the UK, and there's definitely an overlap in the US markets. How do you manage that workload? You get much sleep?
Well, I mean, I guess you've got to. It's very much one of those roles where there's not necessarily defined working hours. You've got to really keep on top of the markets all the time. So you find yourself a lot of the time in the evening, looking at the market, seeing what's happening, looking at the charts. First thing you do in the morning, we all the guys here who work on the desk get up at 5 a.m., check out the markets, see what's happening in Asia overnight, write some commentary on the markets for our clients, and so you've really got to be on top of the markets all the time, which I guess from our perspective is why it's so good that the markets do close on the weekend, so we do actually get a bit of time off.
Okay, and before we get into your take on technical analysis, obviously with your writing, you have to pay attention to the fundamentals and the ratings changes. Would you say you rely more on fundamental analysis or technical analysis?
Well, I guess as you say, in my line of work, we have to be keeping an eye on both. But I think in general, it's always good to have an understanding of what's moving the markets, not just from a technical perspective, but also a fundamental viewpoint as well. Of course, the shorter the time frame that you're involved in a trade for, the less impact the fundamentals have. But then again, but in general, I think overall it helps to have an idea of both. It's all well and good having a very good technical position open or finding a good technical setup using the charts, but if there's a central bank decision coming in 15 minutes, or if there's some big economic data being released, it helps a lot to know what that data is, what that decision is, and how it can impact your trade. So I think the two of these things aren't mutually exclusive. I think having a good idea of both and how it can impact your trading is always going to be beneficial.
Okay, let's go to talk about the technical analysis, and I see that you've had some schooling in it. What kind of techniques do you like, or what are your favorite indicators?
Well, I'd consider myself more of an intraday trader simply because whenever I do have trades open overnight, it can have a quite negative impact on your sleep. If you've got big positions running, then you do find yourself waking up in the middle of the night and checking your trade. So that's never ideal, or not in my opinion anyway. So I'd consider myself more of an intraday trader. I think in terms of indicators, everyone has their favourites which they relate most to. So things like Fibonacci retracement levels I've always found to be quite useful. I'm very much a keen follower of just candlestick analysis. So there's a lot of information you can get, but just by looking at the candlesticks alone. But it's always about using things as a combination. So for me, I'm looking at moving averages, Fibonacci retracement levels, expansion levels. I like to have an oscillator on there, a leading indicator, so stochastic, MACD, RSI, and then just very simple things like trend lines and key support and resistance. And to be honest, there's plenty more indicators which you can use out there, and I'm sure that there's a lot of different indicators which are good in their own way. Things like Ichimoku clouds I know are very good, but personally, I like to keep things as simple as possible.
Yep, the keep it simple, stupid method, the KISS method. We talk about that all the time. So what do you like to trade?
Well, I work for a forex broker, so it benefits me greatly to focus predominantly on the currencies. So things like euro dollar, cable, dollar yen, are always good things to high liquidity, tend to get a lot of volatility in these areas. But of course, it all depends on the time that you're trading. So, say this year, there's been a lot written about how the volatility hasn't necessarily been there in the forex markets as it has in the past. But then you've just got to look around and see what exactly does have volatility. So, looking at all the geopolitical risk that there's been over the past few months, oil has been a great thing to trade. Gold has been a great thing to trade. So you don't have to look too far. And I mean, I know people who don't even like to focus on the majors at all, just because maybe that additional volatility which you can get throughout the day just doesn't really suit them. They prefer things that are less choppy, so they'll maybe look at some of the more minor currency pairs. So maybe looking at things like New Zealand dollar, maybe looking at CAD Swissy, so some of these less traded pairs. But then you tend to get less choppiness in the markets as a result.
So you said you're primarily a day trader. What are your duration of your trades? I mean, do you go into them with a specific entry, a stop, and a target, or is it something where you're going with with a stop, but you try and move your target based on how the trade goes against you? What's your? I mean, I know every instrument that you trade is different, and probably the longer you're in it, the better. But usually, what are the duration of your trades?
Well, I like to start, like I say, I like to have my trades closed by the end of the day. That's the most important thing to me. If I enter a trade first thing in the morning, if it carries on straight until last thing in the day, then that's no problem. It's less the duration of trades. I'm more focused on what I'm actually trying to achieve from the trades. So first and foremost, I'm looking for roughly around a 3-to-1 risk reward ratio. I think tends to be quite healthy.
Correct.
And with respect to stop loss and take profits, don't worry, they are extremely important. But for me, I tend to focus firstly on what I'm trying to. I firstly look for good setups, and if it's got that 3-to-1 risk to reward ratio, then I'll have my take profit set. And I very rarely change my take profit, because I think one of the things which you can be drawn into if your trade's moving well and you're onto a winner, then you can be tempted to move your take profit a little bit further, and and occasionally or quite often that can actually prove quite costly, because when the trade moves against you, you find yourself in a very difficult position of whether to carry on in the trade, or whether to close it out and take a little bit less profit than you would have otherwise liked. So I think by moving your take profit levels, you can be putting yourself in a very uncomfortable position, which is something I try to avoid. Whereas with regards to the stop loss, I have my initial stop loss level, which I always pre-plan before I enter my trade, and then I do tend to move my stop loss in line with the trade, depending on what the price action's doing. So, for example, if the trade moves in line, if the price action moves in line with my trade, and we get a small correction and then a continuation of the move higher, then I may move my stop loss below that next correction, just to try and lock in a little bit of profit along the way.
Okay, and you mean by the end of the day? Are you talking about the end of the UK markets or the US markets, or the?
Ideally, I like to have it by the end of the UK market. So between 4 and 5 p.m. is when I like to have it done. I like to try and enjoy my evenings where possible. And as I mentioned earlier, when you've got trades running, it's very difficult not to continuously check to see how it's doing, which can have an impact on your social life. So, I mean, preferably I like to have it closed out by 4 or 5 o'clock. But if need be, I have been known to let it run as well
Okay.
into the evening.
Okay, and let's switch over here a little bit away from the trading and talk about the big vote coming up for Scotland, the independence vote. Kind of been a shift in sentiment from not thinking it's going to pass to passing. What's your take on that?
Well, I think I've been personally quite surprised by how much support there has been for the yes vote, because I mean, I think the thing that's really struck me, and has struck a lot of people as well that I speak with, is the fact that there's without any guarantees, I personally would find it very difficult to vote for independence. So without guarantees on currency, without guarantees on what your central bank's going to be, on whether you're going to keep the monarchy, without guarantees on whether you're going to join the euro area, there's so many open questions that hasn't really been answered by the yes campaigns, just simply because they don't know the answer. And I think without those answers, I would personally find it very difficult to vote in favour of it and make what would actually be a very permanent change to the country. Now, I know they've acknowledged that it may be difficult to start with, but I think it seems to me like they're potentially underestimating just how difficult a situation they could be leaving themselves in if they do vote yes in 8 days' time. Now, like I said, I've been surprised by how close the vote has been, but that is almost irrelevant because now we've got to deal with what a yes vote could actually do. I think right now it seems to be about 50-50. We saw one poll over the weekend that showed it 51% in favour, 49%
Wow.
against. Now, that didn't include undecided voters, which for me, I think, in my opinion, I would imagine that more undecided voters would be more inclined to vote against independence simply because if they're undecided at this stage and those guarantees don't exist, I'm not exactly sure what it is that would convince them to vote for independence. So for me, I think while it seems to be that the votes are shifting in favour of the yes campaign, I think more of those undecided voters would likely vote against. And I'm still expecting a no vote, if I'm honest, but certainly a much closer race than previously people thought.
Okay, so part of your your coverage has to include the U.S. markets, and just giving us your perspective with the markets here pretty much at all-time highs. Is there any stocks or sectors that you think that eat that haven't really had a big move up or may not decline as much if the market goes into correction? Is there anything that you could alert our traders and investors to? Any sectors or individual issues?
Well, I think that's one of the most difficult things at the moment because what we're seeing in the US markets, take the S&P, the Dow Jones, every time we're moving back towards these record highs as an entire index, we are seeing these corrections, which suggests to me that people are not confident at these levels. And if people aren't confident at these levels now, then how are they going to feel in 6 months' time when we're facing the very realistic chance of an imminent rate hike? So if this is one of the things that really concerns me, as well as the fact that we're seeing these record highs being made on continuously falling trading volumes. So we're seeing participation in the rallies decline. We're seeing technical divergences with the things like the stochastic oscillator. We're seeing divergences between the oscillators and price action, which again just means that we're seeing less momentum in the moves in these moves higher. Earlier this year, we saw a massive increase in the number of IPOs, and that in itself seems to be a sign that the markets, that companies are less confident, that the professional investors aren't really as involved in these stocks. High valuations. We had this. A few months ago, we saw a lot of news reported about the high valuations, in particular in tech stocks, and we saw a big sell-off in tech stocks. But a number of them have recovered again, so we're still seeing some of the same issues there. So I think there's a lot of concerns in the U.S. markets right now, and that's one of the things that makes it very difficult to invest in for me. And I think this is one of the reasons why so many high-profile professionals right now are looking at the U.S. market and saying this is not a selling market. You can't see a market at record highs and sell at these levels, but at the same time, it's not necessarily a buying market either. And I think that's what makes people's jobs so difficult. What I would say is that if you're anticipating, for example, a sell-off, or if you're anticipating a big correction, then maybe just your safer plays can sometimes either be the most profitable or even cost you the least money. If you're not willing to take your money out and hold it in cash, which can sometimes be the safest option, in which we've seen plenty of evidence of a number of fund managers increasing their cash positions. But if you want to keep your money in the markets, then the safe plays, things like the utilities companies, things like the consumer staples, these are the areas where even during these corrections and when economies are struggling, these are the things which seem to do well, just because these are the things which people always need.
You mentioned a rate hike in 6 months. You talking about over here?
Well, yeah, I mean, I think in 6 months or so, it's going to be pretty imminent. I mean, at the moment, the Federal Reserve are talking about the middle of next year, and I personally think that is a bit long. I mean, if we look at the U.S. economy, it's performing very well, and I think had it not been for that first quarter when the weather significantly distorted a lot of the figures, a lot of the economic data, and really had quite a negative impact on the economy, I think we'd be talking about an interest rate hike from the Federal Reserve much sooner than the middle of next year. Probably much more in line with what the Bank of England are talking about, actually, maybe the end of the first quarter of next year. And I think once we start to see wages improve and maybe signs that productivity are improving, I think we're going to see a lot more dissent among the different members of the Federal Reserve, and then that could bring the rate hike forward maybe to either the start of the second quarter or even maybe the third or the fourth month, I'd say, maybe of 2015.
Okay, since we're talking about interest rates and currencies and everything, yeah, do you follow the gold market?
Yeah, I've been keeping a close eye on it. It's been very well supported, really, in recent months. But what we're effectively seeing in gold right now is just a long period of consolidation. Now, we obviously had that massive sell-off back in 2012 when gold just really was at these really record high levels and near these record high levels. And then once we started to talk about interest rate hikes, and we started to talk about the end of quantitative easing, which is actually coming to an end now next month, then we saw gold really start to lose a lot of its value. Now, of course, it's held onto a certain proportion of this, trading around 1250 at the moment. It's held onto a certain proportion of this, and maybe things like geopolitical risk has helped. It has helped support that the price at the moment because of that safe haven aspect. But I think the kind of consolidation that we've seen in gold over the past 12 months or so, it can only last so long. Now, don't get me wrong, it could last another 6-9 months.
Right.
But I do think there is more downside to come in gold in the longer term.
Okay, and finally, you mentioned geopolitical risk, and they're definitely prevalent out there. But the market just seems to, shrug it off. I mean, the Ukraine and Russia, everything that's going on with ISIS. I mean, the market is just climbing the wall, worried. Do you expect that to continue, or do you think the geopolitical situations are eventually going to weigh on the market?
Well, that's actually a very interesting point. There's been so many things going on this year, and there's been so much geopolitical risk out there. But one of the things which we've discussed repeatedly is the fact that despite all this geopolitical risk, like you said, the markets have just shrugged it off. Markets have continued to move higher, and people just seem to have been focusing on other things. Now, I think one of the things that's helped this is the fact that when we're looking at the situation in Iraq, for example, they haven't moved south yet, which is where a number of the oil fields are, which could have had that created a big spike in oil prices, and that tends to have a very negative impact on the economy. At the same time, when you're looking at oil, there's been this big increase in the supply of oil, and there's been falling demand. So while we have seen the increased geopolitical risk, oil prices have continued to fall because demand has not matched supply. It's actually falling against the rising supply in oil. So I think this is one of the things which has actually helped ease concerns here. Looking at Russia, I think this has had the biggest impact on the markets. And we say there's not been a big impact on the markets, but there's certainly been an impact in one way, and that's that particularly in Europe, we've seen that the sanctions which have been imposed on Russia from Europe, from the EU, and vice versa. This is having an impact on the European economy. We are seeing even Germany struggle to get out any kind of growth whatsoever. The rest of the Eurozone economy, which is still extremely fragile, is suffering as a result. Confidence in the economies is starting to fall, and that suggests that this long, slow recovery is actually going to be elongated even further because of these issues with Russia, and that's had an impact on the European markets right now, and it's likely to have an impact going forward, just because we're not going to see the kind of recovery we were potentially hoping for in the next 12 months.
Okay, interesting take. Craig Erlam, market analyst at Alpari, covering a broad range of topics here. Craig, thanks for coming on, and we hope to have you on again.
Thank you very much.
Okay.